The Intelligent Investor by Benjamin Graham, often called the Bible of investing, is not just a book about the stock market. It's a book about human behavior, about patience when others panic and discipline when others chase hype. Warren Buffett once said, "This is the best book on investing ever written." And he was probably right, because the lessons inside aren't about predicting prices. They're about mastering yourself. It's a long, detailed read, hundreds of pages of timeless wisdom. So, in this video, we'll condense it into a few simple lessons that can change the way you see money and investing forever. And whatever you do, don't skip Lesson 4. It's the principle Graham said could summarize all of investing in just 3 words. Now on to our first lesson: think before you act. Benjamin Graham begins by asking a simple question: what makes someone truly intelligent with money? His answer wasn't about an individual outsmarting the market. It was about outlasting it through preparation and discipline. Graham explained it this way: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. In simple terms, if you don't know why you're buying, what you're buying, and how you'll be protected when things go wrong, you're not investing. You're simply gambling. It's the same with everyday life, whether you're buying a car, starting a business, budgeting your income. If safety and reasoning are missing, it's speculation disguised as confidence. Here's what's fascinating. After the 1929 crash, all common stocks were considered speculative. But by the 1960s, everyone who bought stocks, regardless of the purpose, price, or whether for cash or on margin, was called an investor. Graham saw the word investor casually thrown around in financial publications and newspapers. He considered the loose use of the word investor as inappropriate. The word was being applied to everyone in the market, whether they were buying carefully or gambling recklessly. The distinction matters because it determines your entire approach. Money rewards the disciplined, not the impulsive. And here's Graham's warning that most people ignore: speculation isn't illegal or immoral, but it's dangerous when you think you're investing. That confusion is where most people lose money. True investment requires analysis, patience, and honesty. Lesson 2. Control your emotions before they control your money. Graham introduces a character who represents the market's shifting emotions, Mr. Market. Imagine you own a small business. Each day, your partner, Mr. Market, knocks on your door, offering to buy your share or sell you his, but his moods swing wildly. Some days, he's euphoric and quotes high prices. Other days, he's terrified and offers ridiculously low prices. The intelligent investor doesn't argue or panic. He simply chooses when Mr. Market's offer makes sense and ignores him when it doesn't. This is crucial. Mr. Market is there to serve you, not to guide you. In Graham's words, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. Today, Mr. Market shows up as news headlines, viral tweets, and financial influencers shouting predictions. When everyone's loud, the intelligent investor stays calm. Here's something Graham observed. During the Depression, people who owned first mortgages that kept paying interest could tell themselves their investment kept its full value because there were no market quotations to say otherwise. Meanwhile, owners of high-quality listed bonds saw their prices collapse and felt poorer, even though their bonds were actually safer. Graham's point? Sometimes daily price quotes are a disadvantage. They tempt you to act on other people's emotions instead of your own judgment, because every dollar lost in fear becomes another person's opportunity in patience. And remember Graham's most famous warning: the investor's chief problem, and even his worst enemy, is likely to be himself. Lesson 3. Know your investor type. How should we handle investing? Graham says there are 2 kinds of investors: the defensive and the enterprising. The defensive investor values peace of mind, prefers steady, low-effort returns through broad diversification and consistency. This investor wants freedom from bother and is content with average results. Graham suggests the defensive investor maintain a 50-50 split between bonds and stocks, adjusting between 25 to 75% based on market conditions. At the time he wrote this, he estimated a 7.5% before-tax return, though of course that number was specific to his era. The enterprising investor enjoys analysis and is willing to work harder for better-than-average results. But Graham is clear, this investor must devote considerable time and care. It's not about taking bigger risks. It's about doing more work to find better opportunities. Neither is wrong. The only mistake is pretending to be both. Many lose money not because they're foolish, but because they copy strategies that don't fit their temperament. So ask yourself, what kind of investor am I? Because financial intelligence begins with self-awareness. If you're honest about being defensive, you'll avoid the trap of trying to beat the market and instead focus on not beating yourself. Lesson 4. Always keep a margin of safety. Graham gives his most famous principle, the one he said could summarize all of investing in just 3 words: margin of safety. This concept comes from bond investing, where companies were expected to earn several times their interest charges before their bonds qualified as investment grade. That extra cushion protected investors when things went wrong. Always leave room for error in analysis, in spending, in life. Buy below true value. Save more than feels necessary and plan for what can go wrong. Graham explains, the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. Think about that. A margin of safety means your success doesn't depend on being exactly right about the future. A wide margin turns uncertainty into opportunity. For common stocks, the margin of safety might mean buying when the earning power significantly exceeds bond yields, or purchasing stocks at 2/3 or less of their intrinsic value. If you live on 70% of your income, you've built a margin. If you invest with a cushion for mistakes, you've built a margin. If your plan still works, even when you're wrong, you've mastered this rule. The margin of safety isn't fear, it's wisdom. It's how ordinary investors survive what wipes others out. Graham insisted, a true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. Lesson 5. Temperament beats talent every time. Finally, the thread running through the entire book. Success with money isn't about IQ, it's about temperament. Markets test patience and pride far more than intelligence. Graham tells the story of Sir Isaac Newton, one of history's greatest minds. Back in 1720, Newton owned shares in the South Sea Company. He sensed the market was getting irrational and sold them for a 100% profit. Smart move, right? That would have been a cool move, but months later, swept up in the mania, he jumped back in at much higher prices and lost about £20,000, estimated to be over $3 million in today's money. For the rest of his life, Newton prohibited anyone from mentioning the words South Sea in his presence. The intelligent investor stays humble in gains and calm in losses. When everyone rushes, slow down. When everyone panics, stay still. When everyone speculates, think. Wealth grows in stillness, not in noise. During bull markets like that of the 1960s, Graham warned that many investors forgot to ask how much. They bought stocks at any price, assuming growth would justify it. Graham compared this to advice he once gave in a women's magazine. Buy your stocks as you buy your groceries, not as you buy your perfume. In other words, don't buy for the thrill, buy for the value. The truly dreadful losses, he noted, always come when the buyer forgets to ask about price. Decades later, human behavior hasn't changed. Greed, fear, and overconfidence just wear new clothes. Technology evolves, but temperament doesn't. Being intelligent with money isn't about getting rich quickly. It's about staying rich quietly. Every fortune lost begins with abandoning the margin of safety. Every bubble bursts when speculation gets called investment. So build systems, not predictions. Protect your capital before you try to grow it. Think independently when the crowd shouts. Let discipline, humility, and patience be your real returns. Graham left us with one timeless reminder. Investment is most intelligent when it is most businesslike. Every stock is a piece of a real business. Treat it that way. If you found this valuable, hit that like button and subscribe for more timeless wisdom on building wealth intelligently. Check out this video next.